In today's video, I am going to teach you how to use options as a safe and reliable investment strategy. Too often nowadays, option investing has become synonymous with risky bets, but today I'm going to show you one of my favorites and one of the safest ways to use options to make money. Ladies and gentlemen, welcome back to Pandrea Finance. My name is Alex Pandrea, and do we have a video for you today. Now, first things first, at least for this video, I want you to log off of Wall Street Bets, delete all those rocket emojis, and just stop waiting for the AMC short squeeze to happen. So, I'll wait. You know who you are. Good? Great. Well, we're already light years ahead for this video. Now, what I want to focus on in today's video is more of a professional approach when taking a look at option investing in order to broaden our knowledge on different types of investments that we can make using options. Now, I promise that we're going to get into a lot more detail, tips and tricks, and dive much deeper into options in future videos. So do please subscribe if you haven't already. I'll wait again. No big deal. But for me, it's super important, especially in the beginnings of this channel, that we understand how we can safely do the things that we want to do and understand the difference between a good, smart investment and, let's just say, a not so smart, risky bet. Which brings me to one of my favorite options investing strategy. We are talking today about in-the-money leaps using something called delta for directional risk. Now that just sounds very exciting, doesn't it?
Hello, darkness.
Now, this strategy of using options are used by big institutions, billionaire investors, and hedge funds from all around the world. Now, before you comment down below saying, hey, Alex, I thought we hate hedge funds and down with the man or down with the machine, whatever the saying is, eat the rich. I think it's still very important that we all understand the ways that the people who make money and learn as many techniques as possible so that you can have an arsenal, a bag of tricks, if you will, in your back pocket no matter the time, the place, the market situation. We're just gonna learn everything and then you could go and pick and choose your favorite thing and make some money. Now be sure to watch until the end because after you learn this very simple strategy that we're gonna go over in today's video, I will share a bonus tip that I think you might find surprising using this strategy and something that you can do with it that a lot of people don't think of. So if you are ready, go ahead, hit the like button, and let's begin. Alright, so for today's strategy, we are taking a look at how we can use LEAPS option contracts to mirror the investments that we might already be making while buying shares in companies, but we are going to do it with less money, less capital, and for pretty much the same or very similar risk using something very fancy called delta. Now don't be frightened, we're going to go step by step through everything. Now in my last video, I spoke about a strategy that I used to 10x my investment, and that was using out-of-the-money call options on companies that were undervalued. During that time, during the pandemic, it was literally every single one of them. And that strategy of buying out-of-the-money calls was a strategy that was unique to that time and that situation. Now, like I said, this was a unique situation, so for the most part, you won't find yourself in worldwide pandemics where you could take advantage of situations like this to buy out-of-the-money calls. A lot of the times, and a safer way to do it is to buy in-the-money calls, and that is what we are going to focus on in this video. Now, if you haven't seen the video, you can click, is it here? Or is it here? I forgot which side it is. You click somewhere, you watch the video. Now, you might be asking yourself before we even get started, hey Alex, what are LEAPS? That's a good question. LEAPS stands for Long-Term Equity Anticipation Securities. Well, basically what that means is options contracts that expire at least 1 year out. Okay, so generally that would be the definition of LEAPS, the Security Anticipation Securities. Options contracts that expire at least 1 year out, 2 year out, 3 years out, 15 years out. I mean, institutions have the ability to purchase or sell option contracts with decades out. Not as simple Robinhood investors. Now, the idea of using these LEAPS option contracts is to allow investors like you and me to benefit from the underlying stock's price movements while using less capital by putting up less money than you would just by purchasing the shares outright. When you buy one options contract, that represents 100 shares of the company, the underlying company. Whenever I say underlying, just think of what's the company that we are invested in. Now, when you do want to invest in a company, let's say you want to buy 100 shares of a company, it's going to cost you 100 times whatever the stock price is, right? That makes sense. So let's take a look at an example right now. Grab your trusty, loving Robinhood app and open that up. And we're going to go to a company that we all know and love. Let's go with Tesla for today's example. So go ahead, pull up Tesla. And if we go ahead, click on the bottom here and buy, we're going to buy some shares of Tesla. We're not really going to buy them. We're going to go with 100 shares, and we're going to see that the actual price of buying 100 shares is $68,507. Thank you very much, ladies and gentlemen. You're probably saying to yourself, hey Alex, take it easy, chill. I don't have enough money to buy 100 shares of Tesla. You can actually control the same investment, these 100 shares, you can control them by buying one options contract. So here, let me show you what I mean. If we go and click on the bottom here, trade and trade options on Tesla, you'll notice at the top that the contract's expiration dates show up, right? So I want to scroll all the way to the right, and let's just take a look at the last dates of when we can purchase the furthest out contracts. In this case is June 16th, 2023. So we're going to click June 16th, 2023, and the option chain will pop up. Now, if you're seeing this for the first time, don't worry, it's not as confusing as it looks. And the first thing you want to be aware of is that we are buying calls, okay? So call options. So go ahead, click buy on the left side at the top and call on the right side at the top. Now, you'll see in the middle, share price. Now, this shows the share price of the whatever the stock is, $685 in this case, for Tesla. Now, below and above that middle share price middle line, you'll see strike prices, right? So on the left side, there's strike prices that are above $685 and below $685. Now, these are broken up into in the money and out of the money. Out of the money just means that the strike price is above the current share price of Tesla. So anything above $685 is going to be out of the money strike prices. And anything below $685 is going to be in the money strike prices. Now, of course, this is when we buy calls. When we do the put side, they might be a little bit different, but we're only talking about calls. Now, let me show you how this works. Go ahead and click on, let's say, the 650 calls, which is an at the money. At the money just means around $685 what the current price is. Go ahead, click on 650, for example, and we're going to put in one options contract, okay? Don't buy anything just yet. Just take it easy. Just go ahead, put in one, and you'll notice now that a max cost comes up. This is the premium that you're going to pay to control 100 shares of Tesla. Again, you're not actually owning the shares, you're just controlling the 100 shares through this one option contract. Because again, how many shares does one option contract control? Audience, please. 100, you're right. Fast learners, these ones. You can control those 100 shares with about $21,000. Now, if my math serves me right, that is way less than the $67,000 needed to buy 100 shares of the company. So you could already start to see how we can control the same amount using less money, less capital. Now, of course, this example used at the money call options, which is way riskier than just buying the shares outright. One, because you need Tesla stock price to rise above what it is right now, plus the premium paid for you to break even, and then it has to go even above that for you to make money. This is where in the money options come in. And what do we say in the money options are? Well, if we keep scrolling down, further and further down below the share price, the current share price of $684, you're going to get in the money options. And the further in the money you get, the safer your investment is. Well, now it is time to introduce you to something called Delta. Now, Delta is one of those Greeks that you think to yourself, do I need to know this? Do I not need to know this? What do I do, Alex? But this one is very easy. Trust me, we're going to go through it step by step. Delta is defined as the expected change in an option's price relative to $1 movements in the underlying stock's price. So Delta is actually going to help us in determining how the option price moves up or down relative to what the stock does. Now that, as you can see, is very important because we want to know if the stock rises X many dollars, what does that mean for my options price? How much will that increase or decrease in price? So once we understand this, we can better choose what options to purchase based off of the investment strategy and the risk tolerance that we want to go for. Let's take a look at our options. For the options. Get it? So let's go ahead and pull up Tesla again and go through which options to buy using this mysterious delta. So we're going to pull up Tesla, hit trade, trade options, and at the top the expiration dates will appear. You're going to scroll all the way to the right and hit the last date there, June 16th, 2023, and go ahead, click on that, and the option chain will pop up. And let's go ahead again and click on the $650 call, which is around at the money, and you'll see a limit price and a bid-ask spread that pops up that's highlighted in green. You're going to go ahead and click that, and a bunch of stuff is going to come up, and you probably at this point want to smack yourself in the face with your phone. You're like, why am I doing this? Now on the bottom here, you'll see the Greeks. And today's Greek is delta, so it's the first one there. And you'll notice that the delta on this call is 0.6692. Okay, now X out of this, and now go further down, let's say to the $550 call. Click again on the bid ask highlighted green, and now you'll notice that the delta is 0.7435. All right, and let's click out of this and go down to, let's say, the $400 call. Click on the bid ask highlighted green portion and you'll see 0.85. So as you may have noticed, the delta of the option is increasing the further down in the money we go. And the point of using delta is to lower our risk when using options. Now when buying calls, the delta values will range from 0 to +1. So for example, if we have an option with a delta value of 0.25, that means for every $1 the stock moves, the option price will increase by 0.25 or 25 cents. So if an option price, for example, was $5, right, when it started, and it has a delta of 0.25, then when the stock price rises $1, now that option contract will be worth $5.25. Similarly, if we have a delta of 0.75, for example, with every $1 increase in the stock price, the option contract will increase by 75 cents. And going all the way up to a delta of 1 or very close to it, 0.97, 0.99, for every $1 increase that the stock moves, the option price will also increase by $1. And this is what we are going to implement when figuring out which options to buy in our leaps. Now, what does it mean for us when an option price has a delta of 1? So when a stock itself rises and falls and the percentage gains and losses that that stock has, we will see the same equivalent movement in the option pricing. And that is when the delta is 1. So if you want to mirror your investment of 100 shares in a company, we already know that we buy one option contract. And if we want to mirror the exact movements, so the same risk tolerance, right? If a stock goes up 10%, you want our investments to go 10%. You want to look for a delta of 1. So an option contract with a delta of 1 represents 100 shares of the company with the same movements as 100 shares, but we are using less capital, less money for the investment. Now, a quick tip is that you don't need to get exactly a delta of 1 when choosing these options. You can go 0.92, 0.93, 0.95. The point is that it gets close to 1, and those options are deep in the money. So just by knowing that, you know the investment is less risky, and buying in the money options just means that you're already in the money, so you can exercise them whenever you want, because that option will always have value. All right, now that we know all of that, we can put it all together and do a pseudo trade with, again, our Tesla example. So go ahead, open up Tesla, hit trade and trade options. And of course, leaps contracts means at least 1 year out. So let's go all the way to the end. I just like to go all the way to the end, June 16th, 2023. Buy and call. Make sure that is set because sometimes it's on sell, call, sell, put. And you're going to get all discombobulated. It's not going to be fun at all. You're going to be like, I don't know what he's talking about. Now, again, we're going to, what do? Look for an in-the-money call option with a delta of close to 1. Okay, like I said, it doesn't have to be 1. Let's go to the $400 call, bid ask, and you're going to see the delta of 0.85. Closer, still relatively good, but I think we could do better. X out of that. Let's go down to the $300 call. Click on the limit price, bid ask green highlighted, and you go, ooh, delta of 0.9141. That sounds pretty juicy. I like that. And then you take a look at overall what this trade means. Well, you have a $300 call. That means if you purchase this contract, you're going to have the right to buy Tesla at $300 on or before the expiration date. Remember that. You're going to pay a premium of, if we click 1 here, for one contract, it's going to be $40,000, and you're going to control 100 shares of Tesla. Now that $40,000 is the premium that you're going to pay for the right to potentially buy Tesla at $300. And again, this $40,000 is less than the $68,000 that you would have had to put up if you were to buy 100 shares of Tesla. But now we're getting the same risk, the same movement, the same everything, but with less money. And of course, we picked Tesla. It's a more expensive stock, and these prices are outrageous. But of course, this could translate to any of your favorite stocks and companies like AMC. So to recap everything, if you want to mirror your investments that you might already be doing by buying 100 shares in a company, buy the in-the-money call option with a delta of 1. You'll save some money, you'll have the same risk, you'll have the same movement, life will be great. Now, there are a few things that I feel like I have to mention with this type of investment. Firstly, if you're just in this to trade the contracts, we're not talking about exercising shares or getting into the position through options. If we're just trading in and out of the contracts, you will be subject to capital gains tax. And obviously this differs than just holding the shares. If you were to buy 100 shares of the company and you want to hold it for decades to come, pass it down generation to generation, this obviously is two different strategies, and just keep that in mind. Also, the other thing is that you can't really take advantage of things like dividends, right? Payouts from the company, because I know a lot of people who are interested in investing, they go for dividend style investments that pay them monthly income. Now, usually you can replace this monthly income, this passive income type of investment with options by doing a little something called selling covered calls. Now look, for me, selling covered calls is like the 8th greatest wonder of the world, or 9th greatest, or I don't know what number we're at. But now you're just asking yourself, well look, we just bought Leaps. I can't really create passive income and monthly income with that, right Alex? Right, Alex? Well, you are in luck, my friends, because yes, you can. And that brings me to my bonus tip for today's video. There is something called the poor man's covered calls. And now that we own Leaps contracts in an underlying stock, what we can do then is sell shorter term calls on our Leaps contracts as a collateral. Usually you're going to need to put up collateral in covered calls, as in you need the shares of the company. You need to own the shares of the company so you can sell covered calls and collect premium. But because we're buying further out in the money calls, they can always be exercised before the expiration date. So this means we can sell short-term calls on our Leaps positions in the same underlying, obviously, collect the premium, and if it ever gets assigned while we're already in the money with our Leaps contract, we can exercise that and be on our merry way. Now again, if this bonus tip sounded confusing, if you're a beginner out there, do not worry. It did for me as well. But I will be sure in future videos to go in depth into all of these different things. We will learn together, we will succeed together, and I think it's going to be very exciting. Now, if you are new to this channel, go ahead, click on my other videos so you can watch them. Comment down below what you want to learn next. And if you can, go ahead, share this video around. Let's get the word of this channel out there. Thank you so much for watching and sticking around and learning this technique with me. Hope you enjoyed it, and I hope you learned something, and we will see you in the next video.